First panel coming up for the conference. It is on key metrics and risks in critical minerals projects. I'd like to welcome Bert Beatty, who is Partner, Managing Director Australia and Investment Team Leader from Resource Capital Funds. John Dorian, Investment Manager, Orion Resource Partners. Warwick Grigor, Chairman, Far East Capital, and Bert Koth, who is Managing Director and Partner with the Denham Mining Fund within Denham Capital. Please welcome the gentlemen. Thanks for coming along, chaps. I think we discussed previously that we'd like to make this a little bit of an education. I think the audience and much of the industry potentially hears so much about critical minerals, but there are so many different definitions and the lists are extensive depending on where you are. So I thought we'd start just by getting your individual views on what a critical mineral is, and maybe Brett, if we can start over on the far side with you and work our way back.
Sure, no problems. So look, a critical minerals designation is really just a point in time, usually allocated by a government, and we've seen multiple governments have different lists at different points in time. So look, it's a representation that there's an importance there around development and a need for that, and there's different reasons for it, but the reality is it can come and go quite quickly. So I think it's important to recognise that whilst there's an emphasis right now, that as an investor that may not be there in 3 or 4 years' time.
Okay. Bert, if you can take us out of the disco.
We don't like the word critical mineral at all, because for us when we invest somewhere it's more important if it makes money or not, no matter how it's called, right? But put that aside at the moment. Probably critical mineral is for which there's a genuine need, but where the supply side looks challenged, or where the supply side looks controlled by a geopolitical rival. I would say that is the definition of a critical mineral. But again, having said that, for us, such a definition doesn't matter. We invest where we believe we're going to make money, irrespective of how it's called.
Okay. Critical is a bit like calling something green. You know, ASIC's looking at companies that are greenwashing, as they say, trying to find a reason to get investors motivated or punters motivated by the shares. The term critical minerals is in a similar category, in my view. It's trying to capture people's imagination, and everyone's trying to add critical minerals in their stock exchange releases. But as Bert says, look beyond that, look to the economics and get over this hype.
I echo some of what Bert said in terms of, is it a mineral, is it a material, is it a chemical? Understanding the entire supply chain for some of these new and exciting materials, I think is important to do, and not look at them in isolation and just get excited, as Brett has said, by a government list.
Okay.
Under that definition, metallurgical coal will be critical mineral because the supply side is artificially constrained because nothing new gets permitted or financed while demand is growing.
Yeah, it's a good point, but it's obviously a very political term. We talk about Warwick talking about it's something that markets get excited about. It's something that people talk about, and it's, to quote Rick, it's the narrative over the arithmetic. But when we're looking at what's actually critical, what are the things? And I think Bert, we can open it up to Cole if you'd like. But what are the things that you guys are looking at when you consider a critical mineral, like the actual metals that we're considering? I'll start anyway. We may as well go from the other side again. With you, Brett.
Look, for us it's copper. Pick your technology, but you want to move electrons, you need copper. So I think from our perspective, copper mines take a long time to permit and develop. So that's where our focus is in terms of allocating capital. But we like the demand side of the energy transition. So anything where we see an opportunity to make a return whilst not being subject to third-party interference is quite attractive to us. But there are few and far opportunities in some regards, so you really have to diligence quite aggressively.
John, I might just jump back to you to give you a chance to get early this time.
No, I think second, Brett, obviously everyone's very excited and interested by the energy transition, so anything that touches EVs, touches the transition of the grid. But I think, trying to add something different, I think there are lots of different sectors and industries that perhaps could be defined as critical, and maybe thinking about the thematic of nearshoring and friendshoring. There are lots of extensions, as Bert has noted, as to where that criticality could be. So I think there's perhaps some less well-followed sectors that could be of interest.
What are some of those you're thinking of, John?
I mean, you can go as far as you like. I mean, cement, steel, there are lots of industries that are critical, but that aren't particularly well-followed or exciting.
Warwick?
Well, you know, over the years we've seen groupings, base metals, precious metals, now critical minerals. Perhaps we should be calling them new age minerals, because it goes beyond just straight metals. It's lots of different commodities, but essentially they're more industrial minerals, and that requires a greater consideration of marketing, who's buying. Once you get an industrial minerals project up and running and you've got your customers established and you've got the right economics, you can look forward to long life. And industrial minerals often have mine lives of 50 years plus for good quality deposits. So we should be looking at critical minerals more through the eyes of industrial minerals than traditional metals.
For us, it's about first principles. I'm really going to sit on the first quartile of the cost curve, or bottom half of the cost curve. Is a mine or a project in the money under any realistically conceivable price scenario? So that is really the focus of due diligence, and what type of metals or minerals is essentially, I wouldn't say irrelevant, but somewhat secondary, right? As long as the asset quality is maintained and considered in the investment decision. But I mean, if you ask me specifically what you know what we invested in very heavily. We heavily invested in metallurgical coal, in tin, for example, right? We heavily invested in rare earth. But I have to say a lot of the battery metals, what is kind of the hype of the day, you know, we are honestly very cautious about, because there's a technical supply risk and there's a technical demand risk. Nobody really knows where battery technology is traveling over the next 10 to 15 years. And we are not equity market punters. So when we finance the development of mines, it takes 3 to 4 years until the thing is up and running. And then at that point in time, in 3 or 4 years when you want to monetize it, then you need to take a 15-year forward look that somebody is actually going to buy the asset from you at full value. So essentially, we need to be able today to take a 20-year forward look. And honestly, with battery technology, I can't do that.
It sounds a little bit like the term critical minerals is really just
it's a hype.
It's a political term. The lists are so long, they really should be disregarded from an investment perspective, and we should just be bringing it back to probably Warwick's point on the fact that it's maybe new age or a different term. What are some of the minerals and metals that people are looking at today based on the current drivers? And we're largely talking about energy transition, I assume. Warwick, would that be reasonable? Is that your view?
Yeah, I was just going to add another point, that one of the problems with trying to analyse the new age metals, as I call them, is lack of transparency. Not only do you have a lack of transparency in markets, whereas base metals you've got the LME and other pricing mechanisms. So you've got a lack of transparency of how prices are set. At the same time, you have the intervention of the Chinese government, which the Communist Party, which adds another layer of opaqueness. We've seen rare earth prices, we've seen lithium prices collapse over the last 12 months. But you try and figure out exactly why, and it's not easy. The Chinese, particularly in rare earths, uses complex array of subsidies and sponsoring of projects around the world with political objectives. And for the ordinary stock market investor, they've got no chance of really understanding what's happening and why it's happening. They just see it moving, and they'll move money in and out of shares on the basis of that without really understanding what's going on.
It's a nice point to lead us into probably one of the key point for the panel, really, and it's about red flags and what you're looking at, or project assessment to be a little bit more neutral, and how it differs. So if I could ask each of you just to give the audience an idea of what are the key metrics and the key factors that you're looking at for any project, and probably looking at those traditional suites of base and precious and bulks. And then we'll go back through and say how that differs, and I think that probably comes back to Warwick's point. around transparency, but that'd be one of several issues that people need to consider. John, can we start here?
Yeah, so Orion is a private equity long-term investor, much like Brett and Bert in terms of how we invest. So, we do spend a lot of time in diligence focusing on the asset fundamentals that Bert's already characterised. These assets may be very exciting, but they are in more opaque markets. So the emphasis on having assets that are low on the cost curve, where product is well understood, are things that we spend a lot of time focusing on. And on the product side, I think Warwick's touched upon it. You need to spend an awful lot of time with these materials or minerals that are not exchange traded, understanding where that product's going and its value in use, because of the opaqueness of those markets. So offtakes are very important, and coming back to the project engineering fundamentals, has it been done before? Has it been done before recently? Has this management team done it before? And often, the answer may be no, because these are newer materials, and so spending an awful lot of time on the diligence of understanding that engineering of that project and that product that comes out of that project, I think is particularly important for some of these newer materials.
Bert, I know you're very strict on this.
Yeah, for sure. I mean, as fund managers, we all have scars on our back. I think everyone here on this panel for making mistakes. But it's usually the more complexity there is, the higher the risk is of project failure, right? So, which means when you have a copper project or metallurgical coal mine, of which there are dozens of comparable mining, engineering, etc. exist, the execution risk is still high, but it's relatively low compared to the battery metals, for example, right? So we don't like technical complexity because that disproportionately increases the risk of capital failure, right? So all this complicated downstream with graphite anode plants here and lithium hydroxide plants over there, etc., etc. A lot of that complexity, frankly speaking, is not the job of a metals mining investor. These are specialty chemicals disciplines that have actually nothing to do with metals and mining, right? And I believe there's a lot of capital misallocated right now. For example, you have OEMs coming into the space, etc., etc. So I believe there's a lot of capital misallocated right now that will, over the next 6 or 7 years, become significant write-downs of capital, because a lot of these technological challenges that are being underwritten with capital today are not going to be successfully defeated. So for us, it's back to first principles. Avoid any unnecessary complexity, low on the cost curve. I know that sounds like a broken record. Long life mines and something that has a reasonably easily understandable, transparent market. And other things, we're not going to invest in. It's that simple.
Brett, you're nodding along there, a lot resonating for you.
Yeah, look, I've got some scars as well, and I think, we do take those lessons learned. I'll give you an example where we looked at graphite recently and really struggled with the concentration risk out of China. And you compare that with something like tantalum, where we're heavily invested. We were able to take, we had the mines, we purchased our custom, and we were able to integrate that supply chain. So we were able to control where our material went, on what pricing terms, and have a conversation with the end customer. Now that's not for retail markets. We've kept that company private because we don't think public markets would even understand that business. So again, there's challenges around where you're going to get your capital from for certain businesses, because retail markets don't have the understanding of how these businesses work, the time it takes to qualify products and build that relationship with customers. And the reality is there's a lot of third-party sort of influences on these businesses.
Warwick, do you want to carry on some of your earlier points?
Well, I think when we're trying to assess what's a good investment, whether we should be going into the areas, we need to look at capital gain. Is that what you're after? Does that mean that you're punting the stock market hoping with FOMO in play you're going to be able to trade out for a profit? With the more institutional fund managers, they'll go crazy if that's the way they operate all the time. They have to look at the fundamentals. They're after income and growth, and they will want to back real businesses not hot air on the stock market. And I think the perspectives are very different. When it comes down to the industrial minerals products, what's very important for battery manufacturers, for example, anyone in industry, is that they keep their costs low. When you're punting the stock market, people are footloose and fancy free with terminology and expressions they use to pump the share price. But at the end of the day, it comes down to what is the cost to the customer when they're buying the product. And almost no companies that I analyse or analyse as best I can actually comes up with the parameters you need to know on the industrial side whether a project's worthwhile pursuing or not. Most of the companies have never delved deep enough to actually determine what price they need to break even, because they just don't know.
Looking at the risks, specifically in this suite of new age materials, if we're going to call them that, one of the issues we've touched on, market transparency and China's influence in particular. What are some of the metals that you think there's less of an influence there, less of a risk of China basically coming in and manipulating that market, pulling prices down where necessary? What are some of the ones that you would consider that it's not so opaque that regular investors can't understand?
Let's hit the big one. Copper.
Copper.
I'm thinking of the other ones, like the ones that people aren't investing in now for traditional reasons. These suites, some of the things you talked about that people aren't as familiar with, like tantalum, for example, rare earths in general. What are some of the areas where you think the markets are open enough that people can be comfortable with their investments?
It's a difficult question. I'm not sure there's that many on the list. I think what's interesting and where we're watching is Western governments trying to change that. They will be successful in some areas and they'll probably fail in a couple. So I think it's worth watching where capital is being allocated and where certain industries can compete. And we've seen nickel is struggling to compete right now. I think governments are probably more trying to shore up existing producers rather than look to the next generation of nickel assets where they probably can compete with Indonesia. We're not believers in green premiums or the ability to get the middle of the supply chain to pay more. That has to be done by the end customer. So unless you can convince someone to pay $5,000 more for a Tesla, you're not going to get a green premium on lithium, on nickel and other commodities. So.
I'd probably just try and turn it on its head again, go back to that boring point that Bert and I keep making about asset quality. Even in rare earths, Denham and Orion are investors and backers of a very large rare earths project. So yes, it is a market that's heavily influenced by China, but if you have the right asset quality in any of these markets, you can hope to have success.
Which project's that?
It's private, Serra Verde.
Okay.
So you wouldn't be able to invest.
Brazil.
Yes.
But it depends really on the production cost curve, right?
Yes, exactly.
Like in that project, we are definitely can say that significantly cheaper than the Chinese rare earth producers per kilogram, right? And it's up and running, by the way. So from that point of view, the opaqueness of the market doesn't matter. I think what I would say, but I want to answer your question first, which are the markets that are broad enough where you can more comfortably invest without worrying about market distortion? I would add definitely metallurgical coal and potash to that list. Of very bulky commodity markets. But the fact that a market is small or disproportionately influenced by one nation player matters less if you're disciplined enough to only transact when you're really in the bottom of the cost curve, right? I would say for very large markets like copper, potash, metallurgical coal, it might be enough if you're in the bottom 40% of the cost curve, right? For really small niche markets, again, I'm using like whatever, tin, tungsten, right, those areas. I think you really have to be in the bottom 10, 15% of the cost curve, because that's your insurance that some disproportionate market movements move you out of the money. Yeah? Because we have, for example, a very large tin project as well, right? So it's really important that in those more opaque metals, yeah, it's not good enough if you're in the bottom half of the cost curve. Might not be even good enough if you're just in the bottom quartile of the cost curve. But you may have to be in the bottom 10, 15% of the cost curve. And obviously every promoter who walks into our door has a project that's on the bottom 20% of the cost curve. Obviously, by definition, only 20% of the projects can be the 20% of the cost curve, right? So this is why the due diligence is really so important, because you got so many desperate capital seekers out there who will tell you whatever you want to hear to get your money. So this is why the technical due diligence is just so critically important.
Okay. That Bert's comments relate back to the differences between stock market investors and institutional investors that I talked about. If you're an institutional investor, Bert's 100% correct. But if you're a stock market punter, it's actually the projects and the companies with higher cost figures which provide you the greatest leverage. If there's a run going on in the nickel price or the tin price, you don't actually want a conservative company that's guaranteed to make money every day and every night. You want something that's going to go from a marginal project to suddenly profitable because the commodity price has gone up 50%. That's what will motivate the punters on the market. That's where you make your trading profits. So that just emphasises two very different ways of looking at the same situation. Just one other comment on China and its involvement. It's impossible in this world, almost in anything, to avoid the impact of China. It's Chinese involvement will be limited in the more established markets, the base metal markets, and there's only so far they can push one way or the other. But the much thinner markets, the new age metals markets, where they have such a dominant position, that those projects coming on stream, you know, if you do your economics and you think it looks good, and then the commodity price falls by 75%, well, that's pretty dire, and that'll bring most projects undone. It's going to take a number of years, and it'll be self-sorting as you get more and more projects that come on stream. The markets will get deeper, and there'll be more players. It'll be self-sorting over time, but at the moment, it's extremely risky because of the volatility, and we have to get over that. Whether that takes 5 years or 10 years, time will tell.
Okay, I've got a question. I'll come back to Warwick. I'll get him to start with this to give the longer-term investment thinkers a chance to give it a little bit of thought. But it sounds like there's some weird and wonderful things out there that the narrative is going to carry along, and they're going to be great trading opportunities. And they might not necessarily be on a project-by-project basis the best investments for holding. What are some of the things that you're hearing about that you think are really interesting and could carry that narrative, and that it may not meet your investment hurdles because of your own metrics and your own priorities, but that could be really interesting commodities for people to look at, and maybe over the near and then the medium term as well? And I'll start with Warwick. It's an easy one. It's in his wheelhouse.
Well, I think the way to make money in the stock market, you should buy low and sell high. There's so many things that are low now that anyone who's got any money left who hasn't been destroyed already by the market fall should be out there accumulating high quality projects, good grade ones. When I think of rare earths, I think of Lindian Resources. It's hard to go past that, and I've commented that it's such a good deposit, such a high potential profit margin. It's the sort of thing BHP or Rio would come and say, well, we want a rare earths division, give us that company. I think there are so many rare earths projects out there, people don't know what to do with them. They don't know the route to market. Management's got no experience. It's a bit like the dog that caught the car. Well, what do I do with it now? So I think there needs to be more work in actually coming to grips with what are the good projects and what aren't, and get away from the rhetoric that seems to swamp everything. So I don't know if I've answered the question.
Broadly, if nothing else, you've given the other guys a chance to have a think.
Yeah.
John?
A private equity investor, not very good at making market prognostications. But look, I do think the lithium market, the difficulties it's going through, I have to say from a looking at the long term and talking to different businesses that are exposed to that demand profile, things like storage, battery storage, and potentially the changes that will occur to the demand over time, I would hasten to guess that the lithium down part is a temporary phenomenon. Okay. It's about the best you're going to get out of me.
Okay.
I'm not making any market calls.
Not a market call.
No.
Just to what do you find? What's interesting when you're not actually investing in stuff, when you're just reading? What do you find interesting?
Well, look, I mean, there's probably 10, 12 projects out there globally who we consider longer-term investment targets, and that's it.
That's it.
That's it.
All right, Brett.
I'll jump in on lithium. I think we were active sellers of lithium last year, and I think that the downturn in equity markets is an opportunity to get back in. I think the demand side of it is relatively solid, and people can speculate the uptake of electric vehicles, but the reality is batteries just got cheaper, so expect demand to go back up when that sort of pricing outcomes have flowed through the supply chain. So, you know, these windows come and go relatively quickly. I think last year we thought lithium was pretty bananas, but you know, it rose and fell as quickly as you can, and you've got to feel for a CEO in this environment where, you know, governments are sort of prioritising who gets permitted and who gets government funding. Institutions are sort of being dictated from the top in terms of where they should be allocating capital, and then you've got, you know, retail investors swarming as a pack, looking for a 10 times over 6 months and jumping from industry to industry. So it's pretty hard out there for companies really to plan in the long term.
I think we've done a reasonable job covering a lot of the red flags. I wanted to look at when you get strategic investors involved in a project and whether or not that's a good thing. So traditionally you would look at any project really, and if say a major got involved or they got a great offtake partner, and we'd say, yeah, especially for retail investors who may not have the research resources to do a lot of that due diligence, it would be a great signal that it's someone else has done that research and these are good projects. In the critical minerals space, or new age minerals space, or whatever we're calling it, you get a little bit of that, but you get a lot of this government involvement. Is government involvement in these projects something that we should be welcoming, or we should see as a green light as an investor, or should we be cautious about that?
Well, in terms of government, I was horrified to see that the federal government's throwing money at a company which is in the Gina Reinhardt stable. I don't want my tax being spent making Gina Reinhardt richer. If the project's good enough, they should be able to fund it. And we're seeing examples of government throwing big licks of capital into projects, and I scratch my head and I think, well, hang on, this tells me this project's going to fail because they never do their homework properly. They're helping rich people get richer, which is surely not part of the Labor Party platform. And you've got a lot of smaller companies that have got a lot of merit that are struggling because they have to deal with a casino called the stock market. Now, the government's not qualified to know who should be supported and who shouldn't. And it's a very difficult exercise to go through. So there's no easy answer, but surely the answer is not to just throw money at people with lots of money already. You know, an example is, I think Pilbara Minerals got a $500 million grant for a project. Well, there's a company, $5 billion in size, billions of dollars in cash. Why can't they use their own money? Why do they have to use our money? So I think the government approach is very flawed. We do need government intervention to counter what China's doing, but no one's thought it through properly yet.
But
well, I think I agree with you actually. I think in our overtaxed society, throwing valuable taxpayers' dollar at upstream projects is in principle not a good idea. I think what is maybe worthwhile thinking about, and we know the US government is thinking about that, we're staying as a fund very close to some US critical minerals initiatives, is actually to put the downstream in place, because the downstream, frankly speaking, is a place where private investment capital is not very well suited for, because it's usually very capital intensive, it usually has very low returns, etc., etc. So Maybe in a few selective situations, government intervention on the downstream might be a good idea, but I certainly don't think on the upstream. This is not a place for taxpayers' dollar, usually.
Okay.
Look, Chris, I don't mind it in the debt space. I think the conventional banks have not walked away from mining, but are very timid. So I think if you can catalyse that element of the funding package and provide reasonably generous returns, and the taxpayers are getting their money back, then I could sort of live with it. And I think it helps build confidence, a bit like the off-taker or the strategic partner in a project. But the taxpayer playing around in equity markets or trying to pick winners is probably not the best idea. As long as they're coming in at the back end and just solving that debt piece, I think it's ultimately positive for the industry.
For debt pieces as well, I agree with you.
Yep.
I was answering the question specifically on the equity side.
Yeah. But essentially the view is that government giving money to companies that are already doing well is probably a bit of a waste of time.
If they can get it elsewhere, yeah. But there are certain projects that conventional banks just struggle with, whether it's the timing, the offtake, all those sorts of challenges we've been talking about.
And the jury's out on the nickel industry. I mean, Indonesia might have a geological advantage over Australian nickel, just as Australia has a geological advantage in iron ore over others. So, it may just be that they have better low-cost nickel than Australia, period.
Any dissension, John?
No, we're a co-investor with NAIF, the Northern Australia Infrastructure Fund at Sheffield Resources, and I think echoing Brett and Bert on the debt side, they solved an issue for an underbanked sector, a critical materials sector, mineral sands, but it's not very well banked, it's not very well understood, it's quite a volatile market. So NAIF played a really important role there alongside Orion. So I think that's a good part. I would like to see perhaps, governments be more targeted, and I think they are spending a lot of time thinking harder about where their support is required. As Bert said, there's a lot of thinking going on in the US and Australia and Europe as to how best support. One thing I think hasn't been explored, which could be the sort of contingent forms of support, price floors. These might not cost the government very much, but may add an awful lot of confidence to some of these industries and projects, as they do in power, where they offer CFDs in many countries. So that's something I think could be interesting. Okay.
Just getting towards the end of time. Just wondering, does anyone have any questions that things we're not addressing? There's a question at the back. If you could just introduce yourself and then ask your question, that would be great.
Hi, my name's Jeffrey Lecomte. I'm an accountant. Just wondering what the panel thinks of antimony as a critical mineral.
Anyone?
Yeah, well, that is being promoted. You've got batteries, you've got... it's a very small supply mineral. If you're going to call other things critical, you can call that it. But there are companies running around. Often the antimony appears with gold, and you'll see people talking gold equivalent with a lot of that value attributed to antimony. That's happening more and more. But still, it's an industrial mineral, and it's just too hard to predict where the price is going.
We, at our tantalum operation in Western Australia, we have antimony, and I've challenged the guys to start recovering it and trying to sell it, but the reality is it's highly carcinogenic, and the challenges of extracting that material is sort of beyond our capability. But what you'll find is a lot of existing operations are producing some of these niche materials as byproducts. The challenge of a pure antimony or scandium or any of these sort of projects is they're going to add a lot of material to a very small market, and how does that impact the market? Whereas I think a lot of the critical minerals that we can be introducing to the industry where we are today, it should come from byproduct credits rather than pure standalone projects.
Any other questions?
Where does the panel see hydrogen fitting into this new age environment?
In the next 5 years? Not at all. I think it's coming. It's, technology will change the industry, how hydrogen fits in. I think there's a few speculators out there who have a pretty good understanding, but it's just going to take time and patience, I think.
I'd just add, it's a 100 million tonne a year market currently, so that's a big problem to solve. Whether hydrogen plays a role as an energy carrier, I think is a different question, but there's 100 million tonnes of hydrogen being consumed every year, so certainly a big problem to tackle. From fossil fuel, I should say. All that hydrogen's from fossil fuel, so yeah.
Yeah, there's a lot of hype about it, but the reality is very far removed from that hype.
Okay, we are short on time. Sorry, Nathan.
Nathan Ricks from Mining Journal. What do you make of the federal government, the federal opposition's nuclear power plants that seems to be that it'll require a lot of government subsidies to get going? Do you think that would pull away from critical mineral mining? And also, if Australia took a path down the nuclear route rather than wind and solar and batteries and all that, would that make a significant difference to demand for battery metals?
I'll just jump in quickly and say we have got a uranium panel later, and we're running short on time, so anyone who's got a particular view, jump in quickly.
Well, I'd just like to say I'm highly supportive of going nuclear. We should have done it a long time ago. It'll certainly add a lot of stability. I think the cost argument is grossly overstated. The first 5 years of any nuclear power plant are paying lawyers to discuss it. Any smart government who really wants to solve climate change would be going hell for leather with nuclear power. Sooner the better.
I so 500% agree with that.
Anyone else?
I just think Sydney and Melbourne are the logical locations, and I don't think anyone's going to accept that. So, spend away.
That's basically all we have time for. Just in summary, essentially, dismiss the term critical minerals, look at things on a project-by-project basis where you can understand and assess the market and things in the cost curve, the lowest cost curve, relative to the size of the market are probably the takeaways there.
Absolutely.
If you could thank our panel. Thanks, guys. Cheers.